start out with the investment sector, the investment market. And this year, I think, as Paul alluded, we are likely to see investment volumes down. But in the third quarter, because of the closure of a few government land sales projects, and they were awarded in the third quarter, and so investment values doubled from the second quarter. But overall, 2023 has not been too kind on the investment sales market. And I think part of it is on the core asset front, the core holdings, it's the interest rate factor. But I think we are close to the end of the interest rate increases in the US. And of course, Singapore will take the lead out of the US rates. Blue line is our SORA. And but nevertheless, if you look at this, interest rates are likely to stay higher and for longer, even though they are likely to they are expected to dip maybe starting the second half of 2024. So in the meantime, I guess investors are more looking at the future rather than making a decision rather than say, okay, that's the end in sight. If rates have continued to go up, I think everyone will have kept powder dry. So now I think moving forward in 2024, we may begin to see more inquiries in the investment sales market. But still, I think if you look at the overall pool of investments by segment, surprisingly in 2022, 41% of the investment deals that we track came from the commercial sector. And the commercial sector is the income-producing sectors, meaning investors will be extremely yield-driven, sensitive to yield. And in 2022, going back just to say the month of May, I think SORA was 0.2%, and still you got 41%. This year, although the pie has shrunk, but it's still at 40% for the income-producing assets. And all-in borrowing costs is now 4.5% to 5%, depending on the quality of the borrower. Back in 2019, it's the same. It's about 39% commercial. So we know what to expect. It doesn't really vary much. It's just the size of it. It's just that the pie expands or shrinks depending on global sentiments in the region, and interest rates expectations. So this year, we had originally forecast total investment sales to come in at between 24 to 25 billion. We revised that recently to bring it down to 19 to 21 billion. Next year, I guess this will be the base on which we'll start to grow. As I had shown you the chart earlier, we are starting from a relatively low base for investment sales. And with expectations that interest rates have peaked and are starting to come down, I think more and more inquiries will be made. Office may still not see activity because the net yield is approximately 3.3% to 3 to 3.5%. As I told you, borrowing cost is for all in 4.5, 5, so you got negative carry. But retail, you still can get malls trading about 4.5 to slightly over 5. May see some deals there. And industrial, you're seeing 6.25% to 6.5%. I think that's where money will go because you need to have positive carry if you are a private equity investor. So I'll go to the office market. This gives you an indication of how rents have profiled by locations. At the top, these are the brand new buildings that's built in the last 13 to 14 years, Marina Bay area, and then everything else is clustered together. Here is Tampines Regional Centre, and the green line is Harbourfront Fringe CBD. Now, of course, if you look at it, why this is high? It's naturally because these buildings are built in the when the internet came about, whereas some of them are mainly built in the era prior to the internet. And so the floor to ceiling height, the infrastructure is not spec'd up for the modern day office user. So Marina Bay has the highest rent of about close to 1270, and the overall rent is about 965. But by location, it's fine if you saw the previous chart, but this is by grade. We can't really say that our offices are all grade A. In the 90s, yes, you can say that for the reason there was only Raffles Place. But then came the internet and was a game changer in terms of how a building was spec'd out. Building technology changed and we could build floor plates 50, 60,000 square feet. So we broke it down further into three subcategories: AAA, AA, single A. AAA will be like Asia Square, Marina, One Raffles Quay. AA will be UOB Plaza, Republic Plaza, what used to be the cream of the crop back in the 90s, and single A is like this building. So it's not just spec by physical attributes, it's also by location. You can have a AAA spec, but if you're located outside the core areas or the downtown core areas, still within the CBD, we may still classify it as AA. So we see rents here in the AAA subgrade, it's about 1270. Now this is the average rate, effective rate, and it rose 0.1%, AA in quarter on quarter, and then the rest of them, AA rose 0.1%, and then AAA, single A rose 0.2. You may have read that the URA office rental index went up 5.4% quarter on quarter in Q3. So what's the difference between that and ours? URA's index takes lease commencement date as the rent. And if you look at the lease commencement median rent in the third quarter, it spiked up from 1140 plus to $12.11. That's a 7.4% increase for category 1 space. The URA index is an overall grade A category 1 and category 2 office space. So what is category 1? The category 1, in short, is almost similar to our definition of grade A space. Brand new buildings, means AAA, AA, single A. The category 1 rents that went into the, or rather the URA rental index captured rental commencement changes, and that 5.4% seems to be kind of shocking, right, to everyone and counterintuitive. But when we look at the category 1 rents by contractual dates, it actually fell. The URA's rents fell by about, depending how you measure it, 2.8 to 3.2%. So it's more likely that we should look at the contracted rents because that's more intuitive to what we have the feeling on the ground right now. Just clarify why there's a difference between the URA rental index and what transpired on the ground, what we are seeing. Price-wise, this is not effective transacted price, but every quarter we ask our valuers, what do you think a grade A office space will be priced at? And this is an appraised value chart. So yield is about 3 to 3.5% net yield. I think like grade AAA space is approximately $2,900 per square foot. No change. Vacancies, we track both physical and shadow space. So at this point in time, we have 7.1% actual vacancy and plus shadow space. So if you take off the shadow space, it's about 5.5%. So what's shadow space? Shadow space is like you sign on a 5-year lease and then head office says you don't need that much space. I may have 50,000 square feet. So I want to give up 20,000 square feet, but my lease is still ongoing. I cannot give it up. So I look for an agent to find me an alternative tenant, a replacement tenant for that 20,000 square feet. So that 20,000 square feet constitutes shadow space. Its vacancy is rising, but nowhere near here. Okay. Office demand past 5 years, it's about 607,000 square feet. Matching to, in relation to supply, it's quite close. But moving forward, I think we're going to see a little bit more supply of about 750,000 square feet. This year, we had fortunately only Guaco Midtown, which was supposed to TOP last year, but there were some delays. The TOP was obtained in January this year. This year in the CBD, where there's no supply. Next year is both. We have IOI Central Boulevard and Capital Lands Ho-Chiang Road development. So next year we'll see a bumping up in supply, and thereafter it goes down again. So, and I think in short, this is our forecast for rents. I think this should be 2022. It's not 2023. This should be 2022. It went up quite a fair bit. 2023, this year we expect 0.2%. 2024, I think there's going to be some marginal dip in rents. There's no escaping what's happening in the US and what's happening around the world. There's still a tech funding famine and a lot of shadow space. And you can ask Ashley there, head of our commercial listing later, what he thinks about the colors on the market. And I think the office market is getting very complicated and dynamic. Ash and I, in our conversations, it's almost like a sales trader giving his counterparty a briefing every morning. If you're on the equity desk, I was from the equity market, right? So the sales trader would brief the fund manager's sales trader on the other end what he thinks has transpired overnight. You key out what has happened in paragraphs, summaries. And that's almost like the case we are seeing now in the office market. It's changing. To every fortnightly, you have new stories coming in, people giving up space, shadow space in the market. And still, the market has not really settled down to post-pandemic market would look like. Right? The world is in a perma crisis after 2020. Now, this perma crisis has not yet settled because the word goes, it's a perma crisis. You are lunging from one crisis to another crisis, which we cannot tell. So the office market is like this. There's no escaping that hybrid work is here to stay. But the back to office is approximately 85% on average. For the banks, it's 100%. For some organizations like ours, we are working hybrid. We call it 3-2 work week, 3 days in the office, 2 days work from home. So this is the rental forecast next year. I'll move on to private residential. And, well, pickup this year is expected to come in pretty low. Right. Now, year to date, developers have only sold 5,400 units. And that's because, first of all, I think sentiments have been hit because of the rising interest rates. And also developers haven't been launching that many units. 2022, we saw a surge in demand because there was a pent-up force behind the whole scene because of the lockdowns in 2020 and 2021. So developers may have launched fewer units than this year, but the demand came to fill up the projects that were launched prior to 2022 and also those launched in 2022. This is the URA price index for the 3 regions. The breakdown of buyers by nationality. As you can see in the Q3, I think sooner or later, the way that it's going, if the ABSD for foreigner is stuck at 60% for a long time, let's say, we may see this gray part, or rather not this gray part, the foreign content just fizzle out, much like what happened when they implemented the seller stamp duty. The number of people who sold in the sub-sale market. What is sub-sale? Projects that you bought from the developer and you flip before, or you sold before completion. So before TOP, you flip it out, it's called sub-sale. because of the seller stamp duty, nobody is selling in the subsale market, right? You incur a loss. With the 60% ABSD, we may see in some sub-regions hardly any transactions for foreigners moving forward. The future supply is like this. These are completed supply, not launched supply. So, but the future supply has a bearing on the leasing market, and leasing numbers have actually been falling. Part of the reason it fell was the rising rents. We see people move from apartments, individually rented apartments, to those renting, just downsizing to co-living or renting rooms. Because if you rent a room, the inland revenue only captures the master lease as one record of a leasing transaction. So you may have 4 rooms, there's only one transaction. People who come from other, say from a unit that they lease themselves, because of the high rent, they park themselves into a co-living or a room letting, then I think that transaction will just go down. And it's driven because of high rents. So rents, you see, for prime residential rents, it's gone up by 22%, 52% from the start of 2021, and now it's starting to dip a little. It's still quite resilient out there. So what for our outlook? We took the launches from our sister company, associate company, Huttons. In the core central region, there's only Watson House that they will launch. Moving forward, the rest are RCR and OCR projects. So in the core central region, hardly any supply, and all in. We also look at land prices. We work with REA. Real Estate Analytics is a data science company. So they built a hedonic price index for land, government land sales. And we are forecasting that come next year, developers will be exercising caution when it comes to bidding on government land sales. We saw that this year, starting with the Lentor, the Lentor area, prices were like $1,200 per square feet for plot ratio. The latest government land sale is awarded at $950 per square feet. So you can see a major, quite sharp decrease in price per square foot for government land sales in particular area. So, but why are they doing that? It's because they are building in buffer. Developers are building in buffer for any uneventuality should some crisis hit. But it doesn't mean that at the point when they launch it, they will launch it at a discount because they still have inventory in the market. It's just building in the buffer. So all in, this year we will still see about 7% capital value growth. Rents 5 to 10% front loaded to the first half of this year. Next year, I think flat rents has a negative bias of up to 5%. Units sold, developers sales this year about 7,000. New rent resale 11,000. Next year about 8 to 9,000 units in the new sale market, and then resale is about 10,000 units. Industrial market, these are the clusters that JTC has given us, or rather we track it and then we plot our own circles there, we plant the flag there, right? Not all of this is doing well. By location, generally, this part and up to this part. But then when you go to Changi Business Park, it is not doing that particularly well, just like as this is not doing well. So by location, yes, it covers International Business Park, and it covers the good areas cover Changi Business Park. But for the knowledge base and IT back office centers, these are not particularly doing that well. It's only around the Maple Tree Business City that's doing well. But food, Yes, it's doing well here, it's doing well here, it's doing well in the Mandai area. But once you start moving north, kind of quiet. And of course, here, big question mark. I mean, it's too far. Reason is if you need to deliver, your driver can't make 3 trips a day if you are located too far off the main highway. If you are located around here, I think you can get access to the expressway. You can make about 3 trips a day. And so this is how rents have been. Rents in 2020, because of the pandemic, started to squeeze up because of the need to build buffer. You reduce JIT, just-in-time manufacturing, got thrown out of the window. So there was a lack of space and rent started going up. And that momentum built into 222 and 223. But moving forward, we are already starting to see, like in the office sector, we find that tenants do not have capex, do not have head office approval to spend on fitting out works. The same thing is starting to happen in the industrial sector, where some landlord or some tenants have found that the day they did a study of whether to expand or not, the day they try to implement it, costs have gone up multiple times. It's not like 20-30%, multiple times. Cost of doing business in Singapore is pretty high. So I think we're starting to see that on the factory industrial side and also for the logistics side. So some logistics company are starting to take up less space. Our forecast, I think, when we go back, forecast next year is flat for multiple user factory, warehouse is 0.3% increase. Okay. I think finally we have retail. Okay. So rents are like this. Now our rents are different from our peers. These rents are the lock, stock, and barrel rents. It means the passing rent of the entire mall. You get it from our valuer. It's quite pointless to say prime Orchard Road retail malls, retail frontage is at $40-50 per square feet, because it doesn't reflect the entire prime mall's average rent. So we have it at $22.40, but there's a wide range from $29-30 down to the teens, high teens for Orchard Road malls. For the suburban area, it hovers around $13.50 to $17.50, but the bulk of it is around $14.60. So future supply, nothing on the horizon, nothing alarming all the way to 227. And beyond 227, it's at infinity. And so, of course, you see a spike there. Moving forward, or starting from around now, we believe that Orchard Road rents will start to pick up at the expense of the suburban rents and the suburban malls. And this is the reason. Blue line is inbound travelers. Orange line, Singapore residents traveling outward. Now, if you start from here, you take the area, you integrate this and you take the area, you find that this blue line, this orange area, this area under the orange curve line is taken out of suburban expenditure, right? They are traveling out of Singapore. And so that's revenue loss, consumption loss. Whereas the blue line, inbound travelers, sum up the area, that's Orchard Road's benefit, touristy areas. So we see that divergence. There's more travel out. And given the fact that you have inflation here, salaries haven't really gone up that much, we find consumption for the suburban areas starting to be squeezed. Which leads us to this forecast. Next year, I think Orchard Road, we believe rents will still go up, but for the suburban malls, they will remain flat. So that's it for Singapore.